I've been in South Korea for almost a month. Almost a month. I think the people here are great. Orang-orang seru, orang-orang asik. They work super hard. They drink super hard too. And finance is a lot more popular here than in Indonesia. But the trend to finance is super big. And I want to invest in South Korea, well, maybe in its equities. Korean equities could be a play. Tapi looking at its risk, I don't I don't really see how that's gonna favor my investments one day. So my thoughts are okay, once I invest in Korea or you invest in Japan. Um I'm normal I'm leaning to neutral kalau if you're talking about US equities. I think the passive investing trend. Sorry, I have a flu. Sorry. I'm normally I'm lean towards neutral or short in the US equities, especially beta US securities where they make up a ton of the indices. Because I think the investing in passive markets, sorry, in passive style has gone too far. And a lot of these Americans with their Roth IRAs or 401ks, they do, they don't usually stock picks their investment. They want to avoid the idiosyncratic risk when they invest in companies. So they'd rather just invest in the S&P 500 itself. It's an ETF. They pour their money into the ETF. After they pour the money into the ETF managers uh uh gives their shares of the ETF to the buyers. And then when they get more money, they rebalance the portfolio. So I think stock picking will be winner for the next 5 to 10 years until the AI strikes back and then the market becomes more efficient and there's no other way on investing if not passive investing. Yeah. And I truly believe efficient market hypothesis will will be 100% valid, or you could say what's the most valid efficient market hypothesis where private and public information are reflected on its price. I forgot the name. It's on the CFA exam. Oh, let's start into one. Let's start into this one Japanese company. Sorry. Uh, I invest in stable growing companies with a low beta, where usually The ones with low betas. The ones with usually low beta are the low or mid caps, where they're not that correlated to the market. So I have I have virtually almost zero systematic risk if I'm purchasing that stock. But the idiosyncratic risk or the specific risk is super huge. So uh itu masalah yang gue suka rather than gue worrying about the index mau ngarahnya kemana or the global market mau arahnya kemana. I usually just look at the company itself and try not to care about the whole market. Well, carrying the whole market gives you an advantage on knowing what to do, whether you long beta or short beta stocks. But I try to be beta neutral, meaning that my outperformance is not within the luckiness of the index going up. So I'm not a free rider in this business, and I truly generate alpha. That's that's why uh with a small sum of money below $10 million, you don't you don't really invest in big companies. You don't get high PE deals, under the table deals. So make sure there are lots of opportunities out there. If if you are on a bigger scale, then the lower the edge you have on the strategy. So betting against beta strategy wouldn't be a favorable strategy if you have a high assets under management. It will be arbitrage or simply passive investing or simply just picking out mid to large caps and have arrays of investments in your portfolio. Let's see about this company. Uh, the company name is Japan Eyewear Holdings. Japan Eyewear Holdings is uh let's see. It's a thinly traded stock. It only has a 58 billion yen market capitalization. It's a small company. Ya, 380 juta dolar ish. And then translate jadi ya you can say ya 10 triliun kurang lah market cap perusahaannya. So super small. And then this company is super profitable. It doesn't have the 3 years beta. We have to fund it our own self because it's unavailable. Dia baru IPO tahun 2023. What makes this stock how do I say it interesting because nobody follows his name on financial Twitter. Nobody mentions it. It's just several financial influencers. And I don't understand why, because they give reasonable dividend. They have reasonable growth. They have not reasonable, they have amazing growth, and then they're not price as a sky high pricing company. So I would really want to understand what this company does. So looking at the company, gua kemarin do a little bit of this and that. The company IPO tahun 2023. Uh, and if a company, I don't know, tergantung di pasar saham mana ya. Tapi usually kalau lo IPO, usually the max you can go untuk cari financial information atau financial statementsnya, keterbukaannya dia tuh cuma 1 tahun dari 2023 ke belakang. So 2022. I think di Indo juga 1 tahun deh. Gue udah lama banget nggak touch Indo stocks. I think so, yeah. It's a relatively new company untuk di pasar ya. It's not currently trading at the prime market. It's on the standard market. So that also explains why this name is underfollowed and not as liquid as we thought. So, oh yeah, before going to the income statement or the financials, we have to really understand what this company is. Okay. Japan Eyewear Holdings is a company that sells eyewear. Okay. Not just particularly eyewear, but they sell brands of the eyewear. They sell luxury experience for the eyewear buyers or consumers. And then mereka juga super boasting kalau this is made in Japan, made originally in Japan. No Chinese, no Americans, no other manufacturers are involved in this. So this is 100% designed and made in Japan. And also designed and made by Japanese. And it's selling its authenticity like uh like other luxury brands outside LVMH. I don't really trust LVMH. If you're trying to purchase luxury clothing, don't go to LVMH subsidiaries. I wouldn't recommend because they have a lot of cheap looking clothes, but they sell it at millions of its million times its cost of producing it. That's that's not my type. So Japan Eyewear Holdings, they have 28 billion revenue 2025. And uh I don't really care about CAGR kalau misalnya di investor presentation. CAGR dihitung dari mana? Nggak tahu ya. Karena CAGR itu ada bias yang bisa kejadian if you have a low base of starting. You start at 100 and then the next year you start at 200 and then it grows pelan-pelan. Then 100 to 200 will track the number, not showing the true mean of its returns. Jadi uh that's a problem. Terus this company is crazy good. They have like gross profit margin of 77 to 80%. That's amazing. Jadi mereka punya pricing power yang cukup besar. Pricing power yang besar, tapi as I've said before, I don't really like how Louis Vuitton does their business. Tapi this one is reasonable gitu loh. This one is super reasonable. Yeah. What they're selling itu juga high quality materials, and then the one that drives up the price of the eyewear is the how it's made and the story it's being told. And then that's why the pricing power of this company. They have ROE of 25%. That's also crazy good. Equity, but you have to be careful with ROE. This numbers could be inflated or not sure, are not true, showing the true colors, or we an EPS, you can you like, for example, like EPS is earnings per share, right? So earnings net or net income before dividend, of course, net income minus the preferred dividends if they have preferred dividends, divided by weighted average shares throughout the whole year. Now, the shares could be bought back, or the shares or or the shares could be dilutive if they have dilutive securities or complex securities in their capital structure. But let's see. Let's see if they do that or no. Okay. So the company is simple. Mereka, I like simple companies. Nggak susah to understand the company. And I like simple financial structure. I like simple everything. So they have two brands. Yeah, give the most revenue. Actually, they have four brands, but I don't know. Cuma two brands yang dimasukin di sini. The first brand is Kaneko Optical, and the second brand is Four Nines. Uh, it's both of them are luxury eyewears. Tapi I think from what I understand, this company started as Four Nines, and then they merged with Kaneko Optical. And I like mergers or acquisition because it increases economies of scale. Also, second is economies of scope. Economies of scope meaning that you can share the same facility to make different products or differentiated products. It doesn't mean that the product has to be different, but if it goes for a different brand, if it's produced for a different brand, it's also called a differentiated product. So, like I think they merged with Kaneko Optical, and then they merged with Kaneko way before their IPO, and then it's crazy good. So the way how they're selling this is that, yeah, uh authenticity, blah blah blah, and then the consumers really really like it, really really like it. So this is why I said merging or acquiring a company to increase your economies of scale or economies of scope is good. But not every M&A is a good case for every company. Uh, if you are one of the traditional finance scholars, sorry, I gotta take this message. So uh, they acquired Four Nines. Sorry, they merged with Kaneko Optical to bergabung bersama Kaneko Optical karena Kaneko Optical is way more efficient and way more productive with its business flow. So, okay, planning or designing Kaneko Optical itu that the story is being told like Kaneko Optical itu they've always been designing or planning their products in-house. So they have their own people to do it. And then they also have their own production sites. They have two production sites. They have one is for plastic frames and second is for glass frames. Sorry, metal frames, not glass frames. So by having this two production facilities, they could do two brands for their in the same production facility. Jadi bisa buat four nines and then bisa juga buat Kaneko. And currently, four nines, they're still outsourcing to external craftsmen, and that's not a bad way of doing business too. A lot of entrepreneurs outsource their production, but it would be so much better if you're producing at some mass quantity. If if you it will be so much better if you produce at a mass quantity and you have your own production sites. It would really, really increase your economies of scale. I'm not saying that external outsourcing is not gonna increase your economies of scale. No, they offer bundling package, right? The higher the order you have, the lower the price you're gonna have per item or per unit. But it's gonna be drastically different if you have your own production sites and then you are using the production sites super efficiently. And then Kaneko also the way how they sell is not by they don't really rely on wholesale sales or distributors. They distribute their own brand. They have their own boutiques or they have their own stores. It's like it's the same as going into LV or Tory or a Hermes store. It's just the same. Okay. And probably the reason why store sales is super important, it's because number one, it gives the customers or the consumers the experience of purchasing a prideful eyewear, you know, to kayak ngasih tahu to the consumers like they're in their level of life, you can fuck away and purchase 8 million rupiah for an eyewear. 8 million rupiah for an eyewear is outrageous. I purchased one myself, a Xenia. It's super outrageous. And then the experience I had when I purchased the Xenia glass is that uh it's not like it's an ex luxury experience. No, it's more of a normal experience of purchasing an eyewear. But if you go to a exclusive store where that store only exclusively sells an eyewear of their brand, you're gonna have a much far better experience on buying it. And then second, they can control their prices, and then third, they can control quality and etc. They can control, sorry, not by quality of the product, I mean the quality of their sales, man. Their sales, their quality of their sales, how do I say this? Properties. Mereka bisa lihat store saya sendiri and everything. They have 100% control of everything if they sell at the stores. And four nines, they're currently also selling with. I understand why is it in different slides. Four nines, they are selling of 52% on stores, but look at Kaneko. They sell 91.7% on stores. Their own stores. And then, so but you can see, right? The EBITDA margin, if you sell on stores, it's gonna be so higher if you also rather than selling on wholesale. And this is not entirely affected by selling it on store or no, but it's also majorly also affected by if whether it's you are selling it by sorry, whether you're producing it by external outsourcing externals or you make it in-house. So what I'm saying, economies of scale is super important if you massively produce a good, okay? And let's take a look. They have stores, a lot of fucking stores. They try to increase revenue or top line by selling in more stores, selling more quantities, and also increasing the price. Okay, annually 3 to 5%. I think they're just following the inflation rate, and then they could just say, yeah, this is due to inflation. Whether their cost of goods sold is inflated or no in the same fiscal year, they could just say it. And I think it's a good strategy. It's reasonable to compound 3 to 5% of the uh uh glass uh eyewear price if that what they're selling. And also it's super crucial if this Japanese company is selling to overseas customers because if they are mature at their own region, they should sell more to overseas. Masalahnya, if they're mature and they can't sell outside, whatever the reason is, the company is gonna fall off. It doesn't have growth more. Okay. So yeah, this is what they're saying. Okay. They they attempt to have more sales over time and by growing more through growing more stores, opening more stores, and then they try to open stores overseas and then attracting tourists also. Overseas customers also the calculation of the overseas customers is also included by tourists going to Japan, purchasing that eyewear is an overseas customer. Okay. And so yeah, that's what I'm saying also. The third point is integration synergies. By that is economies of scope. Yeah, economies of scope and economies of scale. The point that I've been talking the most. And then if they have enough capital, they want to seek M&A opportunities, which I think is also reasonable. A lot of it's a playbook of the usual compounders. They they invest in their own self until they can't find edge uh on on their own businesses and start acquiring other businesses. And this is what exactly happened to Louis Vuitton. So yeah, uh, I'm quietly bullish on this company because it's so simple. I like it, and it's so straightforward. Yeah, and they want to maintain a 5 to 10%, 5 to 10 store per per year increase. Tapi yang jadi masalah adalah I don't really know the feasibility or the optionality of the projects yang mereka lakuin. So every store I have to know what capital optionality yang bisa lu punya di situ. What capital structure yang lu pakai ketika you open the store. So I don't think the management is dumb as fuck. No, that's not what I'm saying. What I'm trying to say is okay, management is still here. Management is still a human, right? They can make mistakes. Let's say you're opening on a new location site. Let's say you open in Korea, you open in Hongdae, and you open this one store. I don't know. Well, do you lease or do you buy the property? I pretty much sure they lease the property. And then how much more capital expenditures do you spend on renovating the property? And then third one is how fast can you exit the project if how fast can you exit the store if the store is not generating enough revenue or sales to cover the fixed costs. Sorry, to cover the variable costs of that store. So that's one thing. We jangan pernah ngeremehin economics because I think that's super important. If you're if you're still selling above your variable cost, that's all right. If you still have enough cash to burn or on par with the variable cost, that's all right if you have still cash enough to burn. But if you sell below your variable cost and your fixed cost, oh, you fucked up. You gotta exit. You gotta shut down the firm. And that's the same in every case of capital allocations. Okay. Uh, yeah. Also, don't really rely on management guidance because their calculations could be not correct. They have their biases on doing this, but it's good to take a look. What they're planning to do is increasing the sales ratio for overseas customers, meaning that they want to sell more outside. That's it. What they're trying to say is that they want to sell more outside and make this brand a worldwide brand. So like Ray-Ban or I don't know what other glasses are. Gucci glasses. Yeah, and etc. So what they're trying to do is they go to China. Just a great option, also a great strategy because China really loves their luxury goods. They really, really like luxury goods. I don't understand why, but they really like it. Us Asians, we really love luxury goods, right? A lot of LVMH, majority of the LVMH revenue segment comes from China. That that explains it a lot, right? Uh, I don't really care how they want to open their stores and everything. Uh, intinya moving to China is not a bad news at all. But the problem with luxury goods is that if you price the good too high and then it doesn't really justify the value of what you're getting, it's the consumers won't like it and they are more towards inelastic, sorry, more elastic rather than inelastic. What I'm trying to say is that in luxury goods the shift of the price, my hypothesis itu they are elastic. Okay, it's super it's super sensitive. If you if you lower the price, you'll get tons of demands. If you make the price higher, you suddenly have zero demand. But it depends on thousands of variables that I don't understand yet. Tapi that's just my hypothesis. It could be wrong. It could be 100% wrong, totally wrong, and that's fine. I'm here to learn too. Whether it's an elastic or elastic, I think it's totally elastic to this luxury goods. And so yeah, if you have a good that is selling super elastic in the market, any change in income would also be a super major factor of your revenue growth or your sales, meaning that a hurt in the economy or a stagflation in the economy will bring your sales down hard. And especially if you're a big company and you have a lot of mass production sites, it's going to be hard on you because you have a lot of fixed costs. You are not efficient if you're not selling enough. Tapi untungnya they sell eyewears. It's not gonna rot, is it? Ya kan? Okay. Hmm. They have the China stores, Hong Kong stores. Yeah. And then I like it. This is a super simple pitch. Higher the price. Sell more. Sell more by selling to the worldwide. Decrease costs. Decrease variable and fixed costs. Decrease variable cost by economies of scale. Decrease and SG&A by economies of scope. If you have the same person to do the same administrative work, why don't you utilize that person efficiently by doing the same administrative work for another brand? So yeah, I think AI is gonna help too if they can utilize AI. Japs are one of the most smartest humans and the most resilient humans ever on Earth. They try to conquer the world. 45 is where they collapse. And then a bit over 80 years later, they have this amazing, amazing companies there. They have this amazing, amazing cities in there. They're just super resilient. That's what I'm trying to say. Oke, kita lihat ya. How are they doing? Tahun 2022, revenue is 7 billion yen. 2023, so 52% jump in revenue, which is understandable. It's a super normal growth. I believe it's super normal growth. Kayaknya it's a pent-up demand for luxury goods. 2022, consumers lowered their demand and then waiting for their income to go up untuk uh, purchase luxury goods, or this is simply just brand. They established their brand ternyata 2023, or the brand is becoming more mature tahun 2023. I don't know. I don't really care, but the point is it's a super normal growth. It's not gonna sustain. And then you can see it diminishes, right? The revenue growth diminishes from 52% to 26% to 22% to the 2025 full year. And I think it's a good thing to have this growth. It's a super high growth. And then yeah, they maintain a super amazing gross profit margin. 79% gross profit margin. And then they sell eyewear, so meaning that I think almost 100% of their sales are cash. Let's see. Let's see. They're not selling B2B shit. What's wrong with this? Oh, no, 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 no. Don't do indirect. No. As reported cash flow. Oh my God. Okay. Accounts receivables mereka berapa sih? Okay, they have receivables. Oh, that's fine. Okay. And they stack inventory too. Okay. Uh, I need to know how they have their net PPE too. Probably the PPE is right of use of assets, right of use of the lease, depending on the lease, financing lease or the other lease. Forgot what the other lease is. It really depends. Uh, okay. Their goodwill is super inflated. Their goodwill is 13 billion yen. I think this what explains why the book value is super highly inflated. So let's take a look. Total assets is 38,833. You subtract the goodwill, come with 24.8 billion yen of assets, and then you subtract the total liabilities. Equity is 2.4 billion yen. It should be trading. Okay. What the fuck? Hold on. This company, I think their goodwill is as a result of paying too much acquiring a company. I I don't really care because they on that sense, if you're looking at the price to book value multiple, it's not gonna make a lot of sense either. It's gonna be super overvalued if you think it, because it has negative tangible book value. So yeah, but their price to earnings is at 16 times their current earnings. Forward earnings, I think it should be around 14 to 15. So to make sense of the price to earnings, you have to uh put in the growth. So the growth of the company is around what? Let's see the estimates. By 2026, they're gonna have 4 billion net income or 165 earnings per share. 4 billion is uh oops, what? Hold on. They have beaten, oh my God, they have beaten their earnings per share. Okay. Ini ini estimates ya. 2024 they beaten it up. 2025 so high, that's why the shares are jumping that high, I guess. They're accounting for a diminish in growth. Yeah, I don't think that should be the case though. But yeah, if they can sell more, I don't really I don't really doubt why. So there are what 166 again, and they have currently their payout ratio is 24.56%, and the management says that payout ratio should be around 40%. Uh that's okay, that's nice, but make sure to leave some for capital expenditures. I think 60% of the revenue should be enough. Hold on. Sorry, balance sheet. I want to do balance sheet. I need to know what this long-term debt is. How do they finance it? Diriku terjerat cintamu. Miscellaneous. What? No, 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 no. Hmm. Yeah, 40% dividend payout ratio is a nice thing. Okay. On metrics. Hmm. Okay, okay. Let's see their balance sheet. I'm just messing around with Chat IQ. Okay. Uh, Cash 4.4 billion. Huh. Should they should be keep on deploying their working capital if they want to, yeah. Oops, sorry. 2025 di kanan ternyata. Okay, nice, 3.9 billion. And then inventories. Oh, a stack of inventories, I think could be just for the New Year's, or was that productionnya itu lagi di stack up untuk awal-awal tahun, or maybe I don't know. We have to check quarterly reports and find trends. Current assets 7.4 billion. Total assets 38 billion. Okay. ROU 3.7. That means they're leasing more. PPE 4.7 billion. That means they have more equipments or probably to production facility idea. Goodwill, on the other hand, is super high, super inflated. But that doesn't make the company not attractive anymore. It should be just trading uh at the same metric of it. Okay. So lease liabilities, of course. Okay. Okay, that's nice. Okay, hold on. Okay. What do you mean by what do you mean by release shares are scheduled to cancellation? Oh, retires the shares. Oh, oh, that's why. Okay. It's gonna boost the earnings per share. Even though treasury stock method is also gonna boost the shares, but oh, okay, wow. Oh, so they've removed the shares. But right now, oh fuck, it's 2026. So okay, okay, okay. Please analyze the impact if you can. Okay. No, 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 no. 20 for one. Assume net income 4 billion yen. Uh, oh, oh yeah, but the retirements, but buyback period will be until October 31st. So it really depends on their period of purchase of the shares. If they bought the shares back all on January, uh, they will be weighted as 12 per 12 or 1. So the weighted average shares should be as it is. So they plan to 1.2 million shares to be bought back and retired. Oh, that's amazing. Still though, if they uh still though, it's gonna increase the earnings per share. I don't know if the estimates are doing this or no. I'm quite new here, so I'm sorry. So they're projecting full year 2026, it's gonna be 155.8 yen per share. If you have a net income of 4 billion, if you have a net income for 4 billion, uh, or 65, and then the weighted average shares are they count the weighted average shares itu sama, or di January they bought all 1.2 million, which is also impossible because buyback period would be super not wise if they lump sum the money and drove the stock to Valhalla. Mm, it's still gonna boost the earnings per share. If their 4 billion is correct, their earnings per share 65 would be boosted to, I'm guessing, around 117, around 170. But it is suspected that they expect only 155.8 earnings per share. So meaning that the market is pricing in for a depression, or almost like a on contango, yeah, between the management guidance and the market estimate. Well, I think it's amazing. If you can purchase the stock at 2000 or 2000 below, it's definitely a bargain. They have 40% dividend, 80 dividend, 80 yen per share. If they could manage the dividend, if you can manage to have a purchase price of 2200, you're gonna get 3.8%, which is which is not that great, but the capital appreciation would be far greater. Let's just take a look at the stock chart. It's kenapa nih? Hmm. I think ini waktu itu, oh, Agus ya. Probably dividend or what? I think it's gonna be a compounder. And then the thing yang harus gua oh my God. Nggak dikasih. Let's see about peers. Does it have peers? It definitely is a giant. I think the market is also counting for growth. If the earnings per share is if the earnings per share is disappointing, the growth is disappointing, I think the market could really punish it. It's not a net play, it's a growth play on this stock. I think it could be a compounder, but it has a lot of risk. The competition is harsh on this kind of goods. You should really monitor this company if you want to purchase it. Okay, then that's it. Bye bye, everyone. I'm not gonna go deep because I'm gonna lose my edge if I go deep. I don't want to show you how I'm gonna value the company. Hell no, you're gonna value it yourself. Okay, bye bye.